Hi, it's Bob Hoopshire, and this is the Gaining Perspective podcast, where we bring you insightful conversations with some of the top thought leaders in the investment advisor profession and investment management industry. I am the founder of Advisor Perspectives and a vice chairman of Vetify. Several factors point to why this is an exceptional time to invest in small cap stocks. Small caps tend to outperform after inflation peaks and in the aftermath of recessions. Small cap valuations are at 20 plus year lows relative to large cap equities. Earnings revisions for small caps are stabilizing and beginning to outpace those of large caps, and the M&A market is recovering, which historically correlates with improved small cap performance. And my guest today is here to talk about those factors. He is Eric Green, the Chief Investment Officer and a Senior Portfolio Manager and a Senior Partner with Penn Capital. So, Eric, tell me a little bit about your career path, what led you to Penn Capital, and your role there now.
Sure. Thank you first for having me on the show. Um, I started at Penn Capital in 1997. Prior to that, after college, I worked for the Securities and Exchange Commission for 3 years, and then went to business school at the Yale School of Management, where I worked with David Swenson on the endowment. While I was there, volunteered. And then when I graduated, I went over to Penn. We had a couple hundred million under management, and we grew the business to several billion under management for the next 25 years. Started as an analyst. A couple of years later, became a portfolio manager and director of research. And in the last few years, became the chief investment officer.
Well, that must have been quite an experience to be able to work with David Swenson. Let's talk about the macroeconomic backdrop. It looks like inflation is beginning to abate. The Fed is likely to stop raising rates. How do those conditions give risk assets like small cap stocks the potential to outperform?
With lower inflation, it makes it more likely that the Fed is going to stop raising rates and maybe at some point cut rates. Uh, the fact that they're not pushing the economy with higher rates into a recession or reduces the likelihood of a recession allows investors to get more comfortable with taking risk, and more risk is in the small cap market than the large cap market. So we've seen improved sentiment on the small cap side over the last 4 to 6 weeks. And we expect that to continue as investors get more comfortable that we're not headed to a uh, medium to severe recession.
There still is some chance that we would see a recession. How does that factor into the positioning of your portfolio?
Sure, we're looking for if there's valuations that are already incorporating a mild recession, and we're fine owning companies that have usually do not perform well going into a recession. But this time, we've had valuations already correct, such that they're trading at recession levels. That in particular, consumer discretionary areas, some areas, cyclical areas of the market have already had severe corrections as if we were going into a recession in the short term.
Let's talk about fundamentals. Why would investors prefer a small cap over, say, large cap stocks?
Valuations are historically low, as you mentioned earlier, in small cap versus large cap. Small cap companies tend to grow faster over the long haul than large cap companies. They tend to perform much better over the long haul than large cap companies. Over the last several years, large has beaten small, which has created this significant gap in valuations. Also, from a fundamental standpoint, large cap companies are near their peak margins, whereas small cap companies still are far away from peak margins. As the top line with an improving economic environment improves, those margins will go back toward their peak and allows for much faster earnings growth for small companies relative to large cap companies.
Are there areas of the small cap universe that you're particularly finding good opportunities in, or what sectors are you underweighting or avoiding?
So we still believe in the consumer side of consumer sector, consumer discretionary. We The sentiment is very negative on the consumer. I found through my 25 years that the consumer always outperforms sentiment. That everybody thinks the consumer is going to fall apart. But there's some things that I don't think are well understood about the consumer. One is that the increase that we've seen in inflation certainly is a drag on the consumer. However, it's not as bad as what you see in the CPI numbers. So 67% of Americans own their own homes, and most of them have mortgages, long-term mortgages. Their cost, the CPI is over 50% of the CPI is made up of increase in homeowner expenses. That's because mortgages, and it's driven the CPI higher because mortgage rates have gone up. However, a vast majority of Americans don't experience that increase in mortgage rates because they own their own homes or they have long-term fixed mortgages they refinanced or created over the last couple of years before rates went up. So the consumer is not feeling that entire increase, the average consumer of higher CPI, higher inflation. On top of that, they're getting paid a lot more. So salaries have gone up, labor market is much stronger. The consumer is stronger than most people think. If you just think about what's happened in the last month, hundreds of thousands of people spent at least $1,000 to go see Taylor Swift, and they probably spent a lot more than that around that. The consumer is strong, and stocks aren't reflecting the strength of the consumer. So, in areas like gaming, regional gaming, we like hotels, leisure, amusement parks, restaurants. All of them trade at historically low valuations and are already incorporating a massive slowdown in the consumer that we don't think happened.
Yeah, I think the fact that consumer spending tends to generally outperform sentiment is probably the biggest reason why most people are not expecting a recession now. We're starting to see a recovery in the M&A market I mentioned in my introduction. How does that affect small cap stocks?
Sure, I would agree that there is a recovery. It's slow. We're down about 35% year over year on transactions, but the investment banks we talk to, and a lot of the companies we talk to, it sounds like M&A is starting to heat up. Typically, it is much easier for a large cap company to buy a small cap company than to buy another large cap company, or for a small company to buy a larger one. Large cap companies can finance those deals much better. They can also, if they buy a small cap company that has a higher cost of capital, they can refinance that debt using their own capital structure, which allows for a more accretive transaction. Uh, larger, there are typically large premiums paid when a large company buys a small company, and I would say even more so in a period where valuations are much higher for large cap companies and small cap companies. So we expect the M&A market to heat up, and we expect that in our portfolio, I would not be surprised if any of our names were acquired.
The future is fast approaching, and artificial intelligence is positioned to fundamentally change not only society, but financial advisory. Join us on August 30th for VettaFi's AI Symposium, where experts and thought leaders dig into AI and explore its potential impact. Go to etftrends.com/webcasts/artificial-intelligence-symposium.com to learn more and register for the event.
Do you have a preference for growth versus value when it comes to small cap?
The environment has changed over the last couple of years. We're not in a lower forever interest rate environment where rates are going to be 0 to 2%. We think that we're in an environment where there is some inflation. We're going to see 3 to 4% treasuries, at least, maybe up to 5%. That makes value more attractive than growth, in that a couple of years ago, when a growth company, when you're valuing a growth company, you could value their earnings out 10, 20 years at whatever, at 100% of the valuation of those earnings, because the discount rate was zero. Today, when you use a discount rate of 3 or 4 or 5%, where treasuries are trading, those earnings in the out years are worth a lot more, meaning the present value of that company is worth less today than it would have been less worth in a much lower interest rate environment. So on the margin, that favors value over growth. Also, growth has beaten value, just like large has beaten small over the last 7 to 10 years. Those cycles tend to last around 7 to 10 years. And for that reason, growth is much more expensive than value. Now, it's usually a little more expensive because earnings are growing faster, but it is at a extremely wide uh, premium to value today, and we believe that that's starting to turn. Value companies and cyclical companies are mostly value companies, tend to benefit from the near-term economic environment, whereas growth companies, they don't have as much of a benefit in the near term because their earnings are 10, 20, 30 years out in some cases. So we much prefer to be in value industries, energy, industrials, materials, consumer discretionary, rather than the high growth sectors, technology, healthcare, and the defensive sectors of staples and REITs and utilities.
So, for our listeners who are interested in your approach to small cap stocks, tell me a little bit about your mutual fund lineup, the funds that you offer that focus on small caps, their mandate, their risk management processes, expense ratios, and so forth.
Sure. So we have two mutual funds that are one that is a small cap fund called the Penn Capital Special Situations Fund, symbol P as in Paul, S as in Sam, C as in Cat, N as in Nancy, X as in X-ray. That fund focuses 50 to 80 names, focuses on small cap investments, companies that are under 6 billion in market capitalization. That's been around for more than 5 years. You can look up the performance on that fund. I just started to manage our Penn small to mid cap fund, and that it symbols P as in Paul, S as in Sam, M as in Mary, P as in Paul, X as in X-ray. That fund has been around for over 5 years. I just started managing it at the beginning of the year, and that focuses on companies that are a little higher in market capitalization, more in the $3 to $10 billion range on average. Both funds use the same methodology. We do have some overlap between names between the funds, but in general, and I probably should have started with this, half of our assets at Penn Capital are in high yield fixed income. We use the credit market to help us pick stocks. And that strategy for picking stocks goes across all of our equity strategies. Many times, the credit investor knows more about what's going on than the equity investor. And we use all the signals from the credit market to help us determine which stocks to own, what type of market that we're in. I should say today, with high yield spreads near their lows, that usually bodes very well for equities, particularly small cap stocks, over the next 6 to 12 months. The credit market is very accommodative today, putting on our credit hat. And when we look at a company, we may decide to buy the bonds, the stock, the converts, the preferreds, the bank debt. But in the equity portfolios, we only buy the equity. But owning all those pieces of the capital structure really help us understand how where a company is, where it's going in the future, and we believe that provides a competitive advantage to us versus our peers that only look at the equity side.
With credit spreads that tight, that doesn't seem to be indicative of a recession. Is that your take on that?
Absolutely, the credit market in no way is predicting a recession, nor even a large slowdown that maybe gets close to a recession. The credit market is wide open. Companies can refinance bonds if they wanted to. Companies are out there buying their bonds at a discount that they issued at lower rates right now, which we see as a big positive for many of the companies that we own. But yes, the credit market, and the credit market is very healthy. It's actually the healthiest it's been since I followed the credit market over the last 25 years. There are less triple C's in the high yield market than there is normally. There are more double B's than there is normally, and interest coverage is as good as it's been in quite some time, and leverage is as low as it's been in quite some time. Every company pretty much that we follow refinanced their bonds between mid 2020 and early 2022 when rates were coming down. So that means they did fixed rate deals between 5 and 10 years from that period. So there's no maturities coming up in the near term that would cause liquidity issues. We are closely followed. We're probably the only manager you'll talk to who can tell you the bond prices of every stock that we own. The bond prices start to indicate when there are liquidity problems. And bond prices have been, the credit spreads have been very strong over the last, really over the last 6 to 12 months. Uh, the spreads hit over 1100 when we during COVID, and we're down to below 400 on some of the indices and a little above in some of the high yield indices, which is below the historic credit spread.
So you've painted a very rosy picture here for small cap stocks, given the health of the M&A market, the stability in the bond market, and low valuations. What would have to happen in the economy or in the markets to make you less optimistic about small caps?
Sure. I think the Fed getting more aggressive, raising rates to where the Fed had no choice to push the economy into a recession. That would be a real negative for the markets, and risk assets would underperform in those scenarios. Certainly going into more than a mild recession if the Fed kept raising rates. So we would need I would want to watch inflation closely. If inflation starts to move back toward that 5% or higher number, that would be a real negative. That would suggest the Fed needed to do more work, and that work could ultimately push unemployment up and push the economy into a deeper recession than anybody expects right now.
If there's one key takeaway that you would like to leave with our audience of financial advisors about the diligence that they should perform before they select a small cap manager, what would that be?
One thing I would say is don't that the small cap asset class is you're getting paid a premium for volatility. So I wouldn't focus necessarily on a manager that does really well on the downside. I would make sure that that manager does well on the downside, but also captures the upside as well. That volatility is your friend if you plan to invest for 5 years or more in small cap. So what you want to do is make sure that your manager doesn't change its stripes, that consistently their process does not change. The manager is the same manager of the product that produced their prior performance and has that skill set. But I would not focus on very short term numbers. I would focus on longer term numbers, and I would stick with a good small cap manager who's been doing it a long time and has a good track record.
We will include some links in the notes that accompany this podcast where you can learn more about Eric and Penn Capital. There'll be a link to the Penn Capital website, a link to connect with Eric on LinkedIn, and we'll also include links to information about the two mutual funds that Eric mentioned, PSCMX and PSMPX. Eric, is there anything else you'd like to add?
I just want to thank you for your time. I enjoyed it. Bob, you did a great job, and want to thank Advisor Perspective. Happy to do this again one day.
I would look forward to that opportunity. And thank you for listening to the Gaining Perspective podcast with Bob Hoopshire, today featuring Eric Green of Penn Capital. To support our podcast, please share, subscribe, or leave a review to help make our podcast more findable for your friends and colleagues. You can subscribe to Gaining Perspective on iTunes, Spotify, and Stitcher.